Well, hello everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez at Mortgage Works, where we have the answers and they're on the house. We do have one more week of a little bit of a lighting issue, so I'll be light and bright next week when we got our lighting situation figured out. But in the meantime, welcome. Coming to you from Palm Springs in the greater Coachella Valley area. Got a little toasty week going after a lot of cold weather and a lot of rain, which I read, for example, that California, in the first time in 25 years, is officially no longer in a drought of any kind. All the reservoirs are over 100% full, or at least most of them are. So that's the good part of getting a lot of rain, and of course we desperately always need it here in Southern California. Um, I always kind of touch on the sports world. We've got this weekend is pretty going to be pretty exciting with the next, I think it's 4 games for the NFL playoffs. And then we've got, of course, the football national championship on Monday. Still can't believe Indiana is a possible champion. In fact, probably likely. When you hear that school, you always kind of think of basketball, not football. So it's great to see a school that we haven't heard in the football world in college now about to be up on the top. So I'd put my money on them to take it all. So, and of course, for me, baseball, we're 30 days away from pitchers and catchers reporting to spring training. So that's exciting. Can't believe we're already back to that point. After it seems like the season ended actually not that long ago. But and then one other thing, I'm a motor racing fan, so probably the first big event on the motor racing world is coming up in a month from now, the Daytona 500 on February 15th. So that's going to be something to look forward to. All right, let's go ahead and give you a kind of an idea of what's going on in the mortgage and bond markets. We're going to pull up our rate grid that we always do. And it's interesting, all the news headlines and so forth, which I'm going to talk more about in a minute. It's like a shift in the narrative, and it's all very optimistic and upbeat, and that mortgage rates have dropped, quite a bit, and that we're now under 6. Well, I kind of chuckle because, of course, I've been telling you, when you look at our rate grid from week to week, and it continues today, when you look at our rate grid, we're under 6 for sure. And now we're pretty good under 6. In fact, for a conforming conventional rate with a good credit score and decent down payment size, I mean, we're looking at something as low as 5 5/8. There's the rate chart, or the 10-year bond chart, I should say. And what's interesting about that, it looks a little choppy, right? But yet, overall, from last Friday to today, it's virtually unchanged. So I've been pointing this out now for a while. After briefly touching 4% about 6-8 weeks ago, the 10-year bond yield's been jumping around, yes, but in a pretty darn narrow range. Usually in the 410 to 420 range, it seems to be stuck there. And so as a result, of course, as you see today, we're back pretty much to where we were last Friday, with a couple of peaks in between, and then a nice dip yesterday. In fact, I locked in a $3 million refi yesterday. Looks like from that chart we're looking at right now, that was probably a good decision, which of course was made by the borrower, not by me. So again, with that 10-year bond yield as a backdrop, rates on our rate grid are still very attractive. We've been under 5 for a while everybody else seems to be catching up. And as I said earlier, we can get you on a conforming conventional loan with a good credit score and decent down payment. You're in the 5s for sure, and with some cushion, like 5 3/4 down to 5 5/8. The 15-year fix 5 1/8. FHA, VA are down there in the 5 1/4, 5 3/8 range. I mean, it's 5 5 5. There's 5s all across that board for the most part, except for that secondary financing. So, rates are back, if you will, at least in a relative sense. There seems to be, like I said, a kind of a flip of the narrative, and the media and the general public, I think, has suddenly got a little bit more of optimism about rates and the fact that they've gotten better. So let's go ahead and touch on just real quickly what's been going on in the markets as to what is the data points that are the underlying information that's used to establish where those bond yields are going. So this week is inflation week. We had both the release of the CPI and the PPI this week. Remember, last week was all about the labor data points. This week, it's all about the inflation numbers. The first one released, this was on Tuesday, the CPI, that's a consumer price index. It came in 0.3% monthly, and the annual at 2.7%, right on the button, just as forecast. And whenever these numbers come out as forecast, that's always a good thing. That usually keeps the markets calm, and we don't see anything negative happening. Now, when you look at the core CPI, that's again excludes food and energy, which are considered volatile. Then you see more of a mixed issue there. Although, no, excuse me, it's actually also good. 0.2% monthly and 2.6% annual. Again, both of those numbers are a tick lower than forecast. So that was very good news on Tuesday, and I think what led in part to the improved yields in the 10-year bond yield that we saw yesterday, particularly yesterday morning. Then we had the release of the PPI, the producer price index. That's inflation at a wholesale level. That was more of the mixed bag. 0.2% monthly, 3% annual. The monthly figure was right on target, but the annual was higher than expected by a tick. Then the core PPI, again, excluding food and energy, again, mixed as well at 0.2% monthly. That was on target, but the 3.5% annual was above forecast. So that's, again, mixed results, a little bit, therefore, of a deviation from the CPI that was pretty much all good news, all down versus the same or up. And then the only other data point of consequence this week is initial claims came out this morning, 198,000. Forecast was supposed to be 215,000. So that's, less people filing for unemployment than forecast. I don't know about you. That tells me the labor market's doing just fine. Remember last week's employment reports included the unemployment rate dropping by a tick. So with that happening last week, with these initial claims down this week, I don't know about you, but the labor market looks pretty healthy to me relative to the news media suggesting that we're in for some rough times as far as employment goes. So far, I would say the numbers don't show that. With that, there's your update therefore on the mortgage and the bond market. We're going to get back into some more discussion about, is it cheaper to buy a home right now? I say it is. And of course, as Jeff just put up on the screen here, there is a yard sign we can all use. That is for sure. And again, I think there's a shift in psychology and a shift in the narrative where maybe more people are willing to embrace this concept. So we want to kind of go into that even more as we did last week. So the first thing, home affordability, no spin. So what I'm going to do here, Jeff is going to be pulling down some headlines that we've seen here in the last week or so, and I want to kind of touch on each one of them. The first one, it shows here that the analysts note that as 26 begins, that inventory levels that have returned to near normal levels, and of course I mentioned that last week, and that also that's happened is home price growth has cooled. I've been talking about that. The data is there, the Case-Shiller index and so forth. We are seeing home prices cooling. That doesn't necessarily mean in a broad range of markets they're dropping, but certainly the rate of increase in most markets have cooled or tapered off. There is some spotty drops in values, but the point is overall home values are cooling off. Now, you put those two things together, that gives a home buyer more footing, more leverage. If you want to go out starting to get serious about buying a home, you have, with that kind of inventory situation, you're going to have more leverage in negotiating attractive terms for your home purchase. And I want to point out something in terms of the home value issue. Here in the Coachella Valley, again, Palm Springs, we've got other cities here, Cathedral City, Palm Desert, Rancho Mirage, La Quinta, Indio, Coachella, Desert Hot Springs. I want to kind of mention them all. I don't want to leave anybody out. But the point is, we've got a little bit of micro market here. We've got 9 cities, 9 major cities. And in this valley right now, the median home price is $625,000. That's for a single family home, not a condo. Now, you go back to April of 2022, the median home price of a home here in the Coachella Valley was $740,000. So when you look at that, again, that's here in this market. Every market's different, but I would suggest this is indicative of overall what's going on. When you see that, April of 22, median price at $740, same market here in January 26, it's $625. Well, isn't that the kind of improvement in home prices everyone's been looking for? And so if you think of it that way, hopefully this has become a pivotal moment where people are waking up and realizing, hey, wait a minute, we may very well have a pretty good opportunity here. And it could be that we can now finally get into home ownership in a more affordable way. So that first bullet point here in our valley is supported by the data. Home prices have improved by a measurable amount, and that should get prospective home buyers excited. Now, the next bullet point we're going to pull up, it's talking a little bit about the 10-year bond yield. And the predictions here, this comes from Housing Wire, is that the 10-year bond yield is going to be in a range in 2026 of 3.8 to 4.6%. Well, number one, I would say that's a pretty wide range. So it's interesting that they would provide that. In a way, it's kind of, I think, kind of holding back a little bit, holding their cards back in case they don't want to be too aggressive on the downside of that range, and so they want to leave that up to 4.6 in case things snap back. And of course, as a consequence, they also suggest, well, rates could be between 5.75, 5.75 to 6.75 for this year. Well, again, that's a pretty wide range. And so in my mind, that's kind of a weak forecast. It's like they're lacking courage to be a little bit more bold about, can we get that range narrower and more on the lower side. So I'll remind you that most of the major players, Fannie Mae, Freddie Mac, Mortgage Bankers Association, most of those are still forecasting that 2026, the end of 26, rates could still be close to or at 6%. So this current phenomenon, this current optimism, I think could be a little overdone, but we're going to talk a little bit here in just a second of one of the reasons we've got this sudden, improved forecast and improved sentiment about rates, which again, I'll comment on that in just a minute. So I just want you to be aware that yes, things have gotten better in terms of the rate range. I think we are going to be on the lower part of that 3.8 to 4.6 on the 10-year bond yield. I think we are going to stay more in the low 6s to high 5 range. I will point out to you, with all this euphoria about rates have suddenly gotten a lot better, September of 2024, when the Fed lowered the Fed funds rate 0.5%, rates were better than they are right now. People forget that. Now, that was only the case literally for a couple of weeks. And within a few months, by January of 25, rates were back up in the high 6s and starting to approach 7%. So we have been here before, albeit it was extremely short, and so we didn't really see the market, prospective home buyers in particular, really in a great, in big numbers, be able to take advantage of that. So, and with that in mind, again, the third bullet point simply is, the same forecast from Housing Wire estimates that if rates stay below 6.25%, that we could see the market could add about 237,000 of additional existing home sales. Yeah, I think that probably will be the case because, again, what's been the case is that rates overall have been very stable for many, many months, probably the last year or so, but more on the upper end of the, that 5.75 to 6.75 range that Housing Wire is now pointing to now. We've been more on the upper end of that range for most of the last year. What that would mean is 6.25 to 6.75. If there can be just that 0.5% shift to where most of the bounded volatility of mortgage rates is at the lower end of 5.75 to 6.25, that is going to bring out some more buyers. And so I think from that perspective, that kind of forecast of additional 237,000 existing home sales being added to the numbers because of this shift, I think is probably a valid prediction. I would support that. And of course, I'm hoping that will happen because obviously being in the loan business, that's what we want to see. So with that, let's go to the next screen here, because what I want to talk about is get into a little bit more. I know I've talked about it before, buy down strategies, and try to give you or illustrate for you this kind of concept and the fact that affordability is real and it's happening in real time. And I'll be able to give you an example. The first thing, though, I want to kind of go over it once again, we've talked about this before, the temporary interest rate buy downs. These typically come in the form of either what we call a 2-1 or a 3-2-1. So we're going to use a 3-2-1 here to just explain to you in very simple terms the mechanics of this type of rate enhancement. So what it is the 3-2-1 buy down. It's where there's going to be money provided from the seller typically to support or subsidize the interest rate and therefore the payment for the borrower for the first 3 years of the loan. So for the first year, let's say right now, based on all the euphoria about rates have suddenly gotten better, let's use a 5.99 note rate, because a lot of the news headlines are now saying, a lot of the lenders out there are saying, we're now at 5.99. So let's use that as the note rate, 30-year loan at 5.99. Well, with the 3-2-1 buy down, what happens is the first year, the rate to the borrower, and I should say really the payment to the borrower, is going to be calculated based on 3% lower, or 2.99, because the actual interest rate on the loan is still 5.99. It's a 30-year fixed rate loan at 5.99. That's what the note in your loan documents say. The 3-2-1 buy down is essentially a temporary subsidy agreement that's separate to the actual note reflecting a 5.99 loan for 30 years. So in reality, technically speaking, what's happening is the first year, that borrower with a 5.99 mortgage is going to make a payment as if it's a 2.99 mortgage. So they're going to pay to the lender principal and interest based on 2.99. The lender will already have collected from the seller, if it's a purchase transaction, the money to make up the difference. In other words, the payment at 2.99 is what the borrower's paying, but the actual payment has to be based on 5.99. So the difference in dollars between those two principal and interest payments are covered by the buy down funds that were extracted from the seller and then held on account by the lender to use to draw on to cover that gap between the buy down payment and the actual note rate payment. So that's how it works. So in the second year, we do the same thing. It's 2% below, not 3. So you go from 2.99 first year, 3.99 second year, third year it's 1% below. So then it's going to be at 4.99. And then at the end of that buy down period, starting in year 4, you're at 5.99 for the remaining 27 years. So it's really a pretty simple concept. But again, a lot of folks have trouble, following how that works. But the math really is pretty good, pretty simple. So as the next bullet point will show you, this approach eases the initial monthly payment, giving the first-time home buyer breathing room. Now, again, that's interesting. That's more of a psychological thing, because with a 3-2-1 buy down, we're not qualifying the borrower on that first year rate at 2.99. It was that kind of, perspective, that kind of approach that got us in trouble before the Great Recession of 2008. So all home buyers, all home borrowers, if they're going to get a loan with a 3-2-1 buy down feature paid for by the seller, they are not going to be qualified as if the payment's at $2.99 for 30 years. No, that is not done. You're qualified on that fourth year, that note rate full term loan payment of $5.99. That's what you're going to be qualified on. That's what your debt to income ratio is going to be calculated based on. So that way, you're not getting yourself into a loan that you're not going to be able to afford once that buy down period is over. So that's important to understand, and why this can be a very effective option for someone who's now looking at rates have gotten better, home prices have gotten better. I'm going to take those two things, put them together, and go out and start looking for a home. And then if I can layer into that the fact that because home prices have cooled, I can negotiate some seller credit to support financing this kind of approach on my loan, what could be better? I'm now going to get a home that's, good amount less expensive than it was just 3 years ago in April of 22. Plus the fact now I can get a very affordable payment and rate at $2.99 the first year. What better way to attack and be able to successfully achieve affordability in buying a home in these current conditions? So I want to give you one other example in terms of the buy down strategy that I just experienced and just helped somebody with. And this actually is a little bit different idea. It involves a permanent interest rate buy down. So here's the basically what happened. This all happened about a week ago. I got a call from a real estate agent who wanted me to pre-qualify their buyer. And actually, I had already pre-qualified this buyer months before, but they had a desire to hold off and not actually make their purchase or pursue their purchase until early 2026. So it became the case that about a week or so ago, they found a house they seriously were interested in. They wanted to find out about being approved for that particular house and make an offer. So I got contacted to do that, and I was told the home was listed at $475. The agent advised me that they were planning on offering $450, $25,000 below list. So I said, okay, well, I'll prepare the pre-approval and the documentation to go with that based on what you're telling me you're going to do. However, would you mind if I suggest another option? So what I suggested is go ahead and offer $475, but ask for that same $25,000 concession, not off the price, but as a credit from the seller, cash credit from the seller to the buyer. We'll use that to buy down the borrower's rate and pay closing costs. So she liked the idea. The borrowers really liked the idea. And as we got to talking about it more, the agent got wind of the fact that she believed the seller might be happy getting at least $440 for the home. So because of that intelligence, we'll call it, I'm not sure where she got that information, but with that information, we then decided to adjust what the offer was going to be to, again, full list price of $475, and ask for the full amount of seller concession allowed for the loan type. In this case, we were using an FHA loan, which allows a 6% seller concession when you're putting 3.5% down. So the agent submitted the offer at full list $475, asking for $28,500. Well, you know what? That seller accepted the offer same day and accepted the terms requested. $475, $28,500 seller credit. So then what we did with that is our borrowers who had a 688 credit score, okay, call that about a B rating in terms of credit score. Some might be harsh and say B minus, but an okay score, 688. And again, FHA, they're only putting 3.5% down. With that size of a credit, we were able to do a permanent rate buy down to 4.5%. And after covering the points that are required, because that's below market, so there's more and more points involved, the lower below market you go to try to get a rate. So at 4.5%, all the points required for that were paid out of that $28,500 concession credit from the seller, and there was enough money left over. In fact, over $6,000 left over to go toward their other closing costs. So the net result is, talk about affordability. They're getting a $475,000 house with 3.5% down payment. They're getting 30-year fixed for at 4.5% for 30 years. And some of their closing costs are more than $6,000 worth are also being paid for with the seller's money. As a consequence, they're going to be able to get very good monthly payment, very commensurate with what a rent payment would be for a home at this level in terms of value. And they're able to actually own it and be able to go on their way to wealth creation by owning a home. And their out-of-pocket expense is going to be in the neighborhood of around $20,000 plus. So that is a great example. They are ecstatic that they're able to get those kind of terms. They had no idea that that was available or possible after all the drum beating about rates are too high and they're in the sixes and oh my gosh, and the world's coming to an end kind of messages that we've been hearing and have been pounded into us for so long. The environment has changed, and these are the kind of stories that we're trying to create every day. So I want you to at least be aware, if you're thinking about buying, and agents, if you've got somebody who's like, kind of stressed about rates and payments and so forth, these are the kind of things we can help you with to satisfy what they're mostly objecting to and make them feel more comfortable about moving forward, because the conditions really truly have changed and really couldn't be better to take action now. So I'm going to go ahead and go to another slide here, because what I want to do is kind of give you an idea of what's been part of the headlines that has, I think, created a little bit of a difference in this narrative and some improvement in rates. Well, here it is. As you may have heard, within the last few weeks, an announcement was made that $200 billion of mortgage-backed bonds were going to be purchased. It was back on January 8th, actually, a week ago. Trump indicated he was directing, representatives of the system, the federal system, the mortgage housing system, to buy $200 billion of mortgage-backed securities through Fannie Mae and Freddie Mac. And the idea was to drive mortgage rates down, make monthly payments go down, and make the cost of owning a home more affordable. And so the FHFA, Federal Housing Finance Agency, the director of that agency, Bill Pulte, was instructed to make that happen. And as it turned out, as the next bullet point points out, each of these two quasi-federal agencies had $100 billion, I guess, sitting there available to essentially follow these orders and make it happen. So again, Bill Pulte did direct the two agencies to do as the Trump administration suggested, and start making those purchases. And of course, in terms of these mortgage-backed securities, who's buying them? Well, basically just investors in the financial markets. Again, this is most mortgages are pooled together and serve as collateral for mortgage-backed bonds. Those are securities, just like Treasury securities, mortgage-backed securities, corporate bonds and securities. It's just one type of bond that is put out there for sale to anybody. A private individual can buy mortgage-backed securities if they'd like to. So that's who's buying these notes. And the whole idea is by, putting more of these out there, or actually by having the agencies, Fannie Mae and Freddie Mac, the quasi-federal agencies. I always want to make sure I use quasi because they're not part of the federal government. But by putting a directive out there to, basically make those two companies, those two agencies buy this amount of mortgage-backed securities, that increases demand and it pushes down yields. So that has, and in fact, in the second bullet point, of course, it talks about how this is going to, make things more affordable. But in reality, the actual net improvement in mortgage rates hasn't been that crazy substantial. It's been around 10 to 15 basis points. So what we're talking about here is about an eighth improvement in mortgage rates, maybe a quarter on some programs. But the point is, just by this announcement and just by having these two agencies buy just this $100 billion each, which, by the way, is a very tiny part, as it puts in the second bullet point, a very tiny part of the overall mortgage market. And yet, just symbolically, I think it changes the narrative, it changes the psyche of the markets, and it has had an improvement. Mortgage rates suddenly got better, again, about 1/8%, maybe a quarter on some products, but across pretty much all products, even those that are not conforming to Fannie Mae and Freddie Mac. Your jumbos, even the non-QM loans, just the overall rate level of everything in the market in general has gotten slightly better, and you can see it with just about every mortgage program. So the point of this this tactic, if you will, I think was effective, and we have seen improvement just because of the steps that this administration decided to take. And again, I don't want to get political here. I'm not defending the administration per se, but this is, at least so far, it looks like was a pretty good and a pretty harmless way to affect some improvement in rates. The media, the general public has grabbed a hold of that, and I think that's why the psyche, sort of the narrative, has gotten a lot more positive. Still, as it says in the third bullet point, the fact that we're doing this at least gives us some help that we can get back into, as I said in the earlier slide, that lower 6% range on the range, rather than being the higher sixes that we saw, most of last year. And in fact, as it says in the bullet point there, that third one, a year ago, January, we were close to 7%. Now we're essentially at least 1% below that. I would argue a little bit more than that. That does make a difference. And again, that's why I think the narrative has changed more for the positive. And of course, on the next slide are the same charts that we showed you last week. And there's that first one that, again, I just referenced. January of last year, we were close to 7. Now we're, under 6. That kind of improvement is very, very substantial. But I'll argue, I've mentioned it last week, I'll say it again, it was in let's see, 2 years ago in 2023, October, we were at the Freddie Mac posted yield one week they quoted was 7.79, October of 23. So when you look at that, that means that we're currently 2% below the peak of just what, 2.5 years ago, less than 2.5 years ago when it was 7.79. Let's say we're down to 5.75. That's 2%. So in fact, in that regard, let me give you a couple of numbers. In fact, what I'm doing here is I'm going to give you some rate and payment numbers based on different loan amounts. And again, I'll use here in the Coachella Valley, and I don't have a slide for this, but I want to just read these numbers off to you because you're going to be pretty amazed. In the Coachella Valley here, I'm going to use loan amounts of 400, 500, and 600,000. Okay, on a $400,000 loan, going back to October of 23, when you're looking at a rate near 8, I'm going to use 7 7/8. For that $400,000 loan, it was going to be $2,900 a month. Well, now, here we are, January of 26. That same $400,000 loan, you can have it at 5 7/8. I'm using that. You could probably get it 5.75, but we'll be conservative, 5 7/8. The payment, $2,366. That's $534 a month less than it was in October of 23. 500,000 loan amount. October of 23, 7 7/8, your payment would have been $36.25. Now, in January of 25 or 26, that 500 loan amount, $29.57. That's a difference of almost $600 a month. In fact, it is $600 a month. It's actually almost $700 a month. Then, if you go at 600,000 loan amount, October of 23 at 7 7/8, your payment would have been $43.50. And I'm talking principal and interest here. Well, now, January of 26, 5 7/8, $35.49. That's $800 a month less. So these kind of payment savings have occurred, and I think it's a case of a lot of folks just don't realize we've had that much improvement in less than 2.5 years. So if that doesn't get your blood flowing and you get excited about, hey, maybe I can buy a home, I'm reading these numbers to you to give you the idea that things are a lot better than you realize. Again, I always say don't focus on the headlines, beware the headlines, but to the extent you see a headline that gets your interest, dig deeper into the subject. Just don't believe the headline. That's really the point of that. And right now, thankfully, the headlines are suddenly getting more positive and getting people excited about the fact that mortgage rates really have gotten better. And it's true, 2% better in less than 2.5 years. And those correspondingly lower payments that go with that ought to be getting you excited if you've been waiting. That's why you need to have us help you. Give us a call, and I'd be happy to give you some numbers to kind of show you the fact that in reality, things are a lot more affordable than you thought they were. So I'm going to finish up here with just kind of summarize again the other charts that Jeff is showing you in terms of home values and the fact that they plateaued. Again, that's very evident now in the data, and that's something that all home buyers should be taking advantage of. And again, you can see that there on that chart as well. I mean, you take these charts together, the data is there. It tells you the conditions have gotten to a point where there is not really, I think, a rational reason to hold off any longer if you want to own the roof over your head, become a homeowner, start building wealth. Even in times like now with home prices cooling, long term, you're going to build wealth if you own a home versus if you're renting. Don't let go of that thought. and take advantage of these in this environment so that you can actually start the path to achieving that. I think you'll be very happy if you do. So I'm going to summarize here with the last slide. Finally, the time has come. That is what I've been saying. We've got falling rates. We've got increased supply. There's targeted policies like we just talked about with this $200 billion of mortgage-backed security purchases. And all this is converging to make homeownership more affordable than it's been certainly since the pandemic. Absolutely the case. So it's like, kind of like, what are you waiting for? Look at strategies like buydowns, temporary and permanent. We can help you with both. I've just given an example today of a permanent. With those tools, you can attack this head on, and you can be very, very pleased, very comfortable with the outcome. If you just be creative, we can help you with that. We'll do all the numbers for you, and then we can present them to you to show you. It can be a really exciting thing to do, and to do it now while you can take advantage of these conditions. And of course, in that regard, you got to be prepared. Any good agent is not going to take you out, show your homes if you haven't been pre-qualified for the financing you're going to need for that purchase. Same if you go see new homes, a home builder is going to want you to be pre-qualified, pre-approved before they're going to write a sales contract. So get that done. It's going to serve you well in the long run. If you are serious about buying, we can help you with that. Happy to do that for you. We do that all the time. So please call me, email me, send me a text, and I can help you get started on that path. So you're armored and ready to go as a buyer to make the best deal possible in this environment. Okay, so that's what my message today. Again, for home buying affordability in 26, the time is now. The time is here. So let us help you make that dream come true. I think we can do that in a way that you're going to be very happy and very pleased with the outcome. So with that, I want to thank you for watching and listening to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Have a good weekend. Enjoy those playoffs, both NFL and the big college game on Monday. And we'll see you next week on the next edition of the Mortgage Minute. So long. Take care.